Welcome to the Fiscal Physical Podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of the Fiscal Physical Podcast. My name is Aaron, still here with Mr. Ryan Nelson for another week. Ryan, how's the week? How's the day? How's life treating you, my man?
Yeah, life's been good. Week's been good. I'm happy.
Good.
What about you?
I love to hear it, man. Yeah, good news all around on my end here, I suppose. We're just cruising right along through 2026, and just want to make sure to shout out all the listeners who've been, sticking with us here over 2 years of doing this, and lots of episodes out there. So appreciate you guys. Please keep sending us topics, sending us questions, engaging. We'd love that. Email us, podcast@alchemywealth.com. And today we are going to talk about a subject that we've touched on several times throughout this podcast history. There's home ownership decoded. There's, paying off your debts. Like all these, should I pay off my house? A question Ryan gets all the time. So we've kind of touched on what is a mortgage, the loan that builds or breaks your budget, if you want to call it that. But I'm excited to do kind of just a dedicated episode as to, what is a mortgage, Ryan? Like, just so people can kind of understand like what it is as far as in the financial sense of it, and things to kind of, the parts that make it up. So hoping you can dive in a little bit here, and I'll see if you can share some insight.
Cool, let's do it. So yeah, a mortgage. So the mortgage is the loan that you use to buy a house. What's kind of interesting, I think we talked on one of the previous podcasts, is the home is then therefore the collateral. So if I go get a mortgage to buy a house and I don't pay my mortgage, the bank, of course, cares, but not that much, because they'll just take my house from me,
right?
And then they can sell the house and pay off the mortgage, right? So you can imagine the bank is taking a little less risk, and that's why your mortgage rate is like always feels lower than maybe your credit card,
sure,
right?
Yep.
So again, an example we've used, I think, on a previous episode, like if I go buy sushi with my credit card and then don't pay my credit card bill, what's the credit card company going to do? There's nothing. They can't there's no collateral.
Sushi,
right? Yeah. So there's no collateral there. Yeah. Whereas with the home, the bank is taking a lot less risk because they will take over the house, and therefore that's why the mortgage rates are oftentimes lower than something like a credit card. So most mortgages are going to be paid back over a pretty long period of time. The most typical durations you'll see is either a 15-year mortgage or a 30-year mortgage, 30 being the most common. There's 4 parts to a mortgage. So I think we've talked before about PITI. Yep. So that's going to be your principal, interest, taxes, and insurance. So the principal is the amount... The principal is basically the amount that you borrowed, and that's, you can almost think of that as like the core of this. This is like what you've borrowed, what you owe. Interest, that's going to be based on whatever interest rate you owe. You're going to owe some interest on this principal, right? Taxes, typically, so whenever you have this mortgage payment, they combine all this together. And so the taxes is going to be a piece of that, depending on where you live. You could be in a state that has high property taxes or low property taxes, but that would be whatever the taxes are for your property would be included in your mortgage payment. And then typically your homeowner's insurance is also going to be included in that mortgage payment as well, which is kind of interesting. So if we think about this, a lot of people, so there's the principal, interest, mortgage, principal, interest, taxes, and insurance. And so a lot of people think about, man, it'll be nice when I get my house paid off,
sure,
right?
Right.
Well, if you think about these 4 pieces, getting your house paid off removes principal and removes interest. It actually doesn't get rid of the taxes you're going to owe on your property,
right?
Nor does it get rid of your insurance. Technically, most mortgage companies will require you have insurance. If you don't have a mortgage, technically, I suppose you could forego insurance, but most people, that's one of their biggest single assets, so they're going to insure it. So what's interesting is even after you get your house paid off, it's not that you just can live there for free. You're still going to have to pay your taxes and insurance on that property, which a lot of people I find don't actually realize or think about.
Yep, that's a good point.
But all 4 of those together, so the PITI combined, that's just your total mortgage payment or total housing payment. So a couple of kind of key terms, right? So we have the loan amount. That's going to be that principal amount that we talked about. That's going to be the how big of a loan you take. So in other words, it'll be after you've lived in the house for 10 years, it's going to be your home price minus what your equity is going to leave you with your home amount. Your down payment is the amount of money you put up front to buy the house. And so obviously the more money you put up front, the less your payments will be, right? Your interest rate, that's one of the biggest drivers. It is a large driver when it comes to determining what your mortgage payment is going to be. So that interest piece is a big piece. That's variable depending on what current market conditions are. Your loan term, that's that 30 or 15 year. That's the duration of the loan. So that's how many years you have to pay back the loan. One thing that you don't hear as much about anymore, but there's fixed rate mortgages and adjustable rate mortgages. Sure. So if I got a 30-year fixed rate, let's say I got a 30-year fixed rate at 5%, that means I'm going to pay 5% interest rate for all 30 years. If I got a variable rate, there's tons of different ways this could be set up, but maybe I get a variable rate at 3.5%. Well, you say, man, that 3.5% sounds a lot better than 5%, but maybe you're only locked into that for 7 years. And so you still have a 30-year mortgage. You're locked in, at 3.5% for 7 years. But then after that, it could vary to, maybe it goes up to 6 or 7%. And you say, oh my goodness, my mortgage payment just went up a ton. I wasn't bargaining on that. I can't actually afford this, right? Sure. Or the flip side, you could get lucky and interest rates could go down and you actually pay less, right? So adjustable rates are obviously going to be therefore higher risk because you don't know what the mortgage payment is going to be after whatever that fixed time period is. And there's all sorts of different fixed time periods in that adjustable rate mortgage. Amortization is an important term when it comes to mortgages. In particular, I like looking at what are called amortization schedules.
Oh yeah.
And if you look at, you're familiar?
Yeah. Oh yeah, they're awesome. They're super cool.
Exactly. So if you go look,
they're also kind of scary, if we're being honest. You're like, oh no, like that's how much I'm paying in interest.
Yeah. What are you scared of? Yeah. I'm scared of clowns or chainsaws and amortization schedules.
You're like,
yeah.
Okay.
So an amortization schedule basically is going to show you, and you can ask your mortgage company for your amortization schedule, and it'll show you every payment you make. Because you might wonder, you say, oh, I'm paying $2,000 a month, but where's that going? Ryan just said there's the PITI, the principal, interest, taxes, and insurance, but I don't know how much my money's going towards principal or how much is going towards interest or insurance. And so the amortization schedule will break that out for you. And what's interesting is you can see payment number one, if you get a 30-year mortgage, payment number one, a ton of your payment is going to just paying off interest and very little towards principal. Whereas for a 30-year mortgage, what would that be? Payment 360, your last payment, a whole lot more would be going towards principal and very little would be going towards interest because you have very little account balance left at that time. So those amortization schedules can be really eye-opening, and especially when you're new to buying a house and you start looking, you say, "Oh wow!" So these first initial payments I'm making are like almost doing nothing to dropping my loan value. It feels like it's just paying interest, which is interesting.
It also can I think impact on whether you refinance your house or certain things of like how much you've I'm a year into my house. Do I want to refinance that and maybe take on another year to get back to a 30, or am I 10 years, 15 years deep into this schedule? Now I'm really starting to chip away at this. Do I want to restart a 30-year mortgage or something like that too? So it's just really interesting. It's always fun they have the graphs that kind of overlap about cool interest, and then it's they kind of switch places, if you will, as you get farther into it. So super cool. Like I said, most mortgage companies have an online thing and they can provide you with that, and it's pretty interesting to look at.
Yep, for sure. So if you're looking at getting a mortgage, there's a few details or variables that might determine if you get approved, and then if you do get approved, what your rate would be. So your income and the type of your income from work, and if you're self-employed, you need a certain number of years of self-employment income and stuff. So your income and let's call it job stability will make a difference. Your credit score, your debt to income ratio. So how much debt do you have total? So if there could be two people, but one has a whole heck of a lot of debt, and one, two identical people, one has a whole heck of a lot of debt, the other doesn't. Well, it's probably more secure to lend to the person who doesn't have a whole bunch of other debt.
Sure.
So your debt to income ratio is going to matter. How much money you're coming with to put down up front. So are you putting a large down payment down is going to help. What the home value is, of course. And then the loan type. There's a bunch of different loan types that we wouldn't even have time to get into them all in this podcast, but there's different loan types which are going to have different rules for qualification and different interest rates as well. And then another thing to think about with mortgages would be, what does it actually cost? And so there's closing costs. Everybody's probably heard of closing costs,
right?
But
Totally.
those can add up and be a lot more meaningful than people think, right? So there's like lender's fees, there's title, there's escrow, there's appraisals, there's recording fees, and so when you look at all of that together, you can end up paying a lot more to close this house than maybe you were originally bargaining for, and that doesn't go towards your down payment, right? That doesn't go to furnishing the house, like that's just basically a transactional cost. Yep, exactly. And then, of course, once you move in, you have other costs as well. So you're going to have repairs and maintenance, which can add up. You're going to have to pay the utilities. HOAs are seemingly more and more popular. So you got HOA dues. You have what we mentioned earlier, your insurance and taxes. So the TI of the PITI are going to be there basically forever, unless you drop your insurance. But so one thing I think you mentioned at the beginning of the podcast was around sort of how would you budget, like, how would you budget for this mortgage?
Sure. Yep.
And what I find is, at least when I got my mortgage, my first house, I went to the mortgage company and they told me how big of a house I could buy. They pre-approve you. Right. So the process is getting pre-approved. They tell you how much you can afford to buy. And they told me the number. And I just remember like going home and thinking, I'm like, there's no way I can afford that. Like, how could I possibly afford this? I can't, if I bought a house that big, I can't make those monthly payments. Yeah. Right. And so I think a common mistake is sort of relying on the mortgage company to tell you how much you can afford. So oftentimes we haven't done the hard work of analyzing our own budget to know what we can afford. So we go get pre-approved. There's this large institution telling us, hey, we'll give you this much money. And then we just think, oh, okay, cool. That's how much somebody with my income can afford. Right. And that's just, I would say, a common error, but an error you want to avoid.
Definitely. Yeah. I went through a very similar thing when my wife and I, we went through to look at getting pre-approved, and like the amount that we're like, oh, what if we did like a $300,000? The guy's like, absolutely. What about a $400,000? Definitely. 500,000? Sure. And I'm like, wait a minute. Okay, what time does this number stop? You've seen our pay stubs. Like, there's just this. I mean, are we just living in there and not eating anything?
Right.
Kind of thing. Like, it's like, but I mean, if you're the bank's like, hey, we have the collateral of the house. Like, I'll probably lend you what you want, kind of thing. But yeah, it's a very interesting thing of like that pre-approval. You feel kind of awesome about it, and you're like, wait a minute, I definitely can't afford the top end of that sometimes.
Yeah, you're right. I think it's rare that somebody should probably be buying a house that's at the top end of that, right?
Yep.
And so some things to do, more so than a rule of thumb, I would say the best practice would be to, again, do that deep dive into your own personal finances and determine, okay, how much do I need to save for retirement, right? How much do I need in my emergency fund? How much do I spend, month to month on my other expenses? And then you can start to figure out like, okay, this is how much I have left over every month to pay for my mortgage. Then you can start to figure out, well, I need to save up for a down payment. Like, right. You can start to figure all that stuff out. But really, more so than any like percentage, you could go Google and find out, percentages of income you should pay for your house and stuff. But all of those, they're fine rules of thumb, but they don't apply to you and your situation, right?
Definitely.
Like, do you have a kid? Do you not have kids? Are you married? Do you have two incomes? Do you have one income, right? There's just so many variables. Are you living in San Francisco? Or are you living in Nevada? Or are you living in Wyoming? Or are you living in New York, right? Like, there's just so many variables. So I think the best tool is just go through your own kind of budget and figure out how much can I afford to spend every month. And I wouldn't probably allocate every extra penny you have to that mortgage, right? So then the next thing I would say is then you can kind of do some like a test or kind of quiz yourself and say, well, what if a paycheck was late, or what if I was to get laid off, or what if I was to get furloughed? Would I still comfortably be able to make this payment? And if your employer, if something went wrong with your employer's payroll and your check got there a week late and you were relying on that to make your mortgage payment, you probably bought a house that's too expensive.
Sure. Yep.
Right?
That's a great point. Really well thought out kind of way of thinking of that. Like, am I reliant specifically on this? And if that's gone, am I just in trouble
Right.
when it comes to that's a really, really good point.
Yeah. And I would say that, yeah. So just make sure that you have a little bit of budget, a little bit of wiggle room there, if you will. You're going to have repairs on this. You should be budgeting those house repairs into your budget. But, if something came up and you had a $10,000 repair or replaced something, could you do that? And again, if the answer is no, you've probably overspent on your house, right? As far as choosing a mortgage, again, we talked, you're going to choose either a 15 or 30 year. 15 years can oftentimes give you a lower interest rate, but you're going to be paying more per month because you're getting this thing paid off twice as fast. Therefore, you're going to be paying a lot more per month, right? Also choosing between fixed or adjustable. You probably want to work with a mortgage expert on that. The adjustable is going to be higher risk, but also, hey, if you say, hey, I'm moving to this location, I'm only going to live here for 2 years, and then I know I'm going to be relocating. Maybe you don't care. If you're locking into an adjustable rate that's going to lock you into something for 5 years, you say, well, I'm only living there for 2. I'm fine with that, right? So there's certainly scenarios where that could make sense. But you definitely want to do your due diligence there and realize that the adjustable is going to be a little bit riskier. I'd make sure if I'm going into this, shopping rates, talk to different lenders.
Sure. You
don't just want to necessarily work with the first lender you see. You want to go out and do your due diligence, shop different rates. Do a little analysis of your own credit. Oftentimes you can boost your own credit by just, paying down if you're going to pay down your credit card anyways, paying it down before they run your credit can help. Right. So there's a couple things you could do just to increase your odds. And then you mentioned at the top of the podcast, right? One of the most common questions I get is, should I pay my house off early, right? And so I know we've gone into more detail in previous episodes, so I'll keep it quick here. But, paying off that mortgage can oftentimes be like a more of an emotional decision than a rational decision.
Sure.
And, it can feel really good to not have that weight, because these are oftentimes big pieces of debt. For most people, it's their biggest piece of debt. And so if you're debt adverse, this could feel really kind of looming, hanging over your head. And so getting it paid off can feel really great. But doing a comparison between what your current interest rate is on the house and what your expected returns in investment accounts could be, and doing a comparison there could help you determine kind of what, makes the most sense in the spreadsheet. Yep. And then again, you can make your own decision based on your own personal values. So whatever supports whatever is in alignment with your values, I'm good with. And I think the reality is we've gone into a lot more detail than that in a previous podcast. So, all in all, I'd say, don't just buy the biggest house the bank will let you. Like, make sure that like the house supports your lifestyle and goals and family goals, but also fits your retirement goals and your travel goals and all your other finances. And so again, if you start at that level of walking through your budget, figuring out how much you can spend and coming up with your own number as opposed to relying on somebody else, I'd say that's probably the biggest takeaway.
Yep. No, I think that's all super well said. And I remember I think we talked about it on the previous episode about like, should I pay this off? You think if you have a $500,000 mortgage, it's like, wow, that's a really big number. Like, I want to pay that off. I want to be free of that, if you will. But you're never quite free of it because you got still got your property taxes, you got your insurance you're going to have to pay for. And then you think about like, if I spend the next 10 years paying off $500,000, for example, like, what is my rate of return on that? Is my house going to go up potentially 7% a year? Maybe, I don't know, but like historically, like with the stock market, you pivot and put 500,000 of that over the next 10 years into your retirement. Probably over the next 20 years, you're going to see a little bit better return on that kind of investment.
What's interesting though, I don't want to go too far down this rabbit hole, but what's interesting is let's pretend your house did get a 7% return and your investment account got a 7% return. Your house gets that 7% return whether or not you put, say, an extra $1,000 in it or not. If in your retirement account, let's say a brokerage account, if you don't put that $1,000 in the brokerage account, that $1,000 is not growing. Right. The value of your house, you own your house, if it grows by 7%, it grows by 7% whether or not you have a mortgage on it or not, or whether you put the extra $1,000 in it or not. So your comparison, you would want to make sure you're not comparing what you think the house rates are going to grow by to what market rates are going to grow by. You'd want to compare what the interest rate of your house is compared to investment returns. So small nuance there, but
absolutely, but important as well too to kind of call that out for sure. So awesome, Ryan. Well, I feel like I learned something here. We'll go ahead and take a quick pause here. We'll be back on the other side of this, and everybody hang tight with us.
And now to put the personal in personal finance.
Welcome back to this side of the Fiscal Physical podcast, the personal side, if you will. So, Ryan, this one, a lot of these questions revolve around food. I like that for sure. But I'm curious with this question here. Do you have a comfort food? Something that stands out, maybe something your parents made back in the day, or your significant other, or something that just, you're like, I'm sick, I want to eat this, or I had a hard day, I want to get this. Do you have a comfort food that you have a go-to for?
Not really. I don't know that. Yeah, I don't know that I necessarily have a comfort food. I like pizza.
Sure.
Pizza is my favorite food. So I guess if like something that'd be like, I suppose by default, my comfort food. But yeah, I don't know that I have like in a time of stress or something, I want a particular food. It's just like I always want pizza regardless of the situation.
Could be stressed, not stressed, asleep, awake,
exactly.
Whatever it is. So.
There's no situation. So yeah, it happens to check the stress box or the comfort food box, but just because it checks every food box.
Yeah,
but,
that checks out. Yeah, for
what
sure.
What about you?
But, no, I mean, I'm similar. I don't really have something that I'm like, I really want this. But a lot of times when I'm not feeling super well or it gets cold, I like soups a lot. Sure. And my wife makes an Olive Garden recipe.
Soup
Toscana. Exactly. Yeah. That we're actually having it tomorrow, and I'm really excited about it. So I get super excited about that. Super excited, if you will. And that's one of my just go-tos when it's cold. I'm maybe not feeling well. I want like a hearty meal. That just always makes me feel good. Like that first bite, I'm like, oh yeah, it warms me right up and everything. So if I had to choose one, I'm guessing that's probably my comfort food, if you will. But I'm curious about there. A lot of times people have things that their parents used to make, or their mom or dad, or whatever it might be, like grandparents. Like my grandma used to make this pasta that I really used to like. So super curious to see what everybody else has to say out there. We'd love to hear your thoughts and around that comfort food there. But other than that, Ryan, I'm just going to let the listeners know these podcasts drop every Tuesday morning. Set your watch to that. We appreciate everybody out there absorbing this content, whether it be through Spotify, Apple Podcasts, wherever you get your listens. And I'll let you, Ryan, play us out to end the episode here.
As always, stay the course.
Thank you for joining us for the Fiscal Physical Podcast. Until next time, happy listening. And as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode. And consider leaving us a rating and review on your favorite platform. This helps other listeners like you find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your Fiscal Physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.